My friend, let me tell you something I learned many years ago through countless hours of watching the tape. The market does not lie, but the tools we use to interpret it often do. I have spent my life studying price, not theories, not predictions, not fancy formulas that promise to tell you what will happen next. I studied what actually happened, and from that observation I discovered something profound. Price itself tells you everything you need to know. You do not need indicators, you do not need oscillators, you do not need anything except your eyes, your mind, and your discipline. Today I want to share with you the principles I have built my entire understanding upon. These are not tricks, they are not shortcuts, they are laws. Laws that govern every market, in every era, forever. If you can learn to read price the way I will teach you, you will never look at a chart the same way again. Let us begin. When I first came to Wall Street, I was like most young men. I wanted to make money quickly. I wanted to find the secret. I thought there must be some hidden formula, some indicator, some system that the professionals used to beat the market. I tried everything. I followed tips. I listened to rumors. I bought newsletters. I studied every new method that promised success, and I lost money. Not because I was unintelligent, but because I was looking in the wrong place. I was looking for something outside of price to tell me what price would do. Do you see the absurdity in that? It took me years to realize it. The answer was always right in front of me. Price is the final arbiter of value. Price is where buyers and sellers agree. Price is the only thing that matters. Everything else is commentary. Everything else is interpretation. Everything else is delayed, derived, and often wrong. So I made a decision. I would stop looking at everything except price itself. I would watch how it moved. I would study its behavior. I would learn to read its language. And that decision changed everything. Let me explain why indicators fail. An indicator is nothing more than a mathematical formula applied to past price data. It takes what has already happened and transforms it into a line, a histogram, a number. But here is the problem. The market does not care about your formula. The market does not wait for your indicator to confirm. By the time your indicator gives you a signal, the professionals have already acted. The big operators, the men who move markets, they do not use indicators. They create the price movements that your indicators try to interpret. They are already in before your moving average crosses. They are already out before your oscillator shows overbought. You are always late, always reacting, always one step behind. This is why so many traders lose. They are trading the shadow, not the substance. They are trading the echo, not the sound. They are trading the reflection, not the reality. Price is reality. Price is what happened. Price is the truth. If you want to understand the market, you must go directly to the source. You must learn to read price itself. Now let me share with you the foundation of everything I teach. There are 3 fundamental laws that govern all market movement. I call them the law of supply and demand, the law of cause and effect, and the law of effort versus result. These are not theories. These are observations of natural law as it applies to markets. If you understand these 3 laws, you will understand 90% of what moves price. Let us take them one by one. The first law is the law of supply and demand. This is simple but profound. When demand exceeds supply, price rises. When supply exceeds demand, price falls. When supply and demand are in balance, price moves sideways. You do not need an indicator to tell you this. You can see it in the price action itself. When price is rising steadily, with strong movements and little reaction, you know demand is in control. When price is falling steadily, with weak rallies and strong declines, you know supply is in control. When price is moving sideways, chopping back and forth in a range, You know the forces are balanced, but here is what most traders miss. Supply and demand are not static. They are constantly shifting. The key is to identify when the balance is about to change, and you do that by watching price behavior. Does price struggle to go higher even though volume is present? That suggests supply is coming in. Does price refuse to go lower even when it is hit with selling? That suggests demand is absorbing the supply. These are the clues. They are subtle, but they are always there. You just have to learn to see them. The second law is the law of cause and effect. This law states that before any significant movement in price, there must be preparation. I call this preparation cause. The effect is the subsequent move up or down. The size of the cause determines the size of the effect. Let me explain what I mean. When large operators want to accumulate a position, they cannot simply buy all at once. If they did, price would rise too quickly and they would pay too much, so they must buy over time, quietly, without alerting the public. This creates a period of sideways movement, a range, a consolidation. During this time, price is held in check while the operator absorbs all available supply. This is the cause. The longer this process takes, the more stock changes hands. The more stock that changes hands, the larger the eventual move will be. When the operator is finished accumulating, he allows price to rise. This is the effect. The same process happens in reverse at tops. The operator distributes his holdings to the public over time. Price moves sideways again, but this time the character is different. Once distribution is complete, price falls. Again, the effect matches the cause. You can measure this. You can see it in the width of the range, the amount of time spent, and the volume patterns. You do not need any indicator. You only need to observe. The third law is the law of effort versus result. This is perhaps the most powerful tool for reading price action. Effort is represented by volume. Result is represented by price movement. In a healthy trend, effort and result are in harmony. When there is heavy volume, price should move significantly. When there is light volume, price should move less. But when you see disharmony between effort and result, you have discovered something important. If you see heavy volume but little price movement, what does that tell you? It tells you that one side is absorbing the other. If price is rising and you see enormous volume but the range is small, that is supply coming in. The buyers are pushing, but sellers are meeting them. This is a warning sign. Conversely, if price is falling and you see heavy volume but price does not decline much, that is demand coming in. The sellers are pushing, but buyers are absorbing. This is a sign of strength. You can also see effort versus result in the opposite way. If price rises sharply on very light volume, that tells you there is no supply. The path is clear. If price falls sharply on very light volume, that tells you there is no demand. No one is defending it. These relationships are everywhere. Once you train your eye to see them, you will never miss them again. Now let me tell you about the operators, the men who control the markets. I am not speaking of conspiracy. I am speaking of reality. Markets are not moved by the crowd. Markets are moved by concentrated capital, by men who have the resources, the information, and the patience to move price where they want it to go. These operators think differently than the public. They do not chase price. They create price. They accumulate when everyone else is fearful. They distribute when everyone else is greedy. They understand that the public will always buy at the top and sell at the bottom, because the public trades on emotion. The operator trades on logic. If you want to succeed in the markets, you must learn to think like the operator. You must learn to see what he is doing, and you can see it if you know what to look for. Let me describe accumulation to you. Accumulation occurs after a decline. Price has fallen, often sharply. The public is discouraged. They have lost money. They want out. The operator begins to buy, but he must do so carefully. He cannot let price rise too soon, or he will not get enough stock. So he supports the price on declines and restrains it on rallies. This creates a trading range, a zone where price oscillates back and forth. To the untrained eye, this looks like a boring sideways market, but to the trained eye, this is the most important phase of the entire cycle. During this phase, the operator is transferring stock from weak hands to strong hands, from the public to himself. You can identify accumulation by watching the character of the price action. In the early stages, price will test the lows. It will probe downward, looking for more supply. If there is no more supply, price will hold. The tests will become shallower. Volume will dry up on the declines. This tells you the supply is exhausted. Then you will see price begin to rally. But the rallies will be contained at first. They will be stopped by resistance. This is the operator testing the overhead supply. How much selling is there? How much can he absorb? Over time, the rallies will become stronger. The declines will become weaker. The range will shift upward. And finally, when the operator is ready, price will break out. It will leave the range with strength, with volume, with conviction. This is the beginning of the markup phase, and if you have identified the accumulation correctly, you can enter at the right time. Not with an indicator, but with an understanding of what the operator has done. Distribution is the mirror image of accumulation. It occurs after a rise. Price has advanced, often significantly. The public is excited. They are confident. They want more. The operator begins to sell, but he must do so carefully. He cannot dump his entire position at once, or he will collapse the price. So he sells into rallies and supports the price on declines. This creates another trading range, but the character is different. In accumulation, the tests go down and the rallies are restrained. In distribution, the rallies fail and the support is artificial. You will see price push to new highs, but the upward momentum weakens. The volume may increase, but the range narrows. This is effort without result. The buying is not strong enough to continue the advance. Then you will see price begin to decline. The declines will be sharp. The rallies will be weak. The operator is no longer supporting the market. He is gone. And when the last of his stock has been sold, price will break down. It will leave the range with weakness, with conviction, with no support. This is the beginning of the markdown phase. If you have identified the distribution correctly, you can exit before the decline. Or you can position yourself to profit from the fall. Again, not with an indicator, but with an understanding of what has occurred. Let me now teach you how to read strength and weakness. This is the essence of price action reading. Every movement in price reveals something about the balance of power between buyers and sellers. You must learn to interpret these movements. A strong market is one where rallies are sharp and reactions are shallow, where volume increases on the advance and decreases on the decline, where price holds above prior support levels, where each new high is higher than the last. These are signs of demand in control. A weak market is the opposite. Rallies are sluggish and short-lived. Declines are sharp and sustained. Volume increases on the decline and decreases on the rally. Price breaks below prior support. Each new low is lower than the last. These are signs of supply in control. But the real skill is in recognizing the transition, when strength is turning to weakness, when weakness is turning to strength. This is where fortunes are made, and this is where most traders fail, because they do not see it until it is too late. Let me give you an example. Suppose price has been rising steadily. Each rally is strong. Each reaction is shallow. Then one day, price rallies to a new high, but the rally is not as strong as the previous ones. The range is smaller. The volume is heavy, but the result is weak. This is a warning. Then price reacts. The reaction is deeper than the previous ones. It breaks below a prior low. This is confirmation. The character has changed. Demand is no longer in control. Supply is entering. You do not need an indicator to tell you this. You can see it in the price action itself. And if you see it early, you can act. You can exit your position. You can wait for a better entry. You can even position yourself for the reversal. This is the power of reading price. Now, let me speak to you about the mind. Because the greatest obstacle to reading price is not the market. It is yourself, your emotions, your biases, your need to be right. These will distort your perception. They will cause you to see what you want to see instead of what is actually there. I have seen traders who could read price perfectly, but who could not control their emotions. They would identify accumulation, wait for the breakout, and then enter too late because they were afraid. Or they would see distribution, recognize the danger, and then hold on because they were greedy. Or they would miss the signals entirely because they were focused on their profit and loss instead of the price itself. The market does not care about your emotions. The market does not care about your opinion. The market simply is. If you want to read it accurately, you must approach it with a clear mind. You must be objective. You must be detached. You must be patient. This is harder than any technical skill, but it is essential. Patience is the trader's greatest weapon. The market spends most of its time doing nothing, moving sideways, consolidating, digesting prior moves. This is when the operator is working. This is when the cause is being built. But this is also when most traders lose their discipline. They become impatient. They want action. They enter trades that have no basis. They chase price. They overtrade. And they lose. I learned long ago that the best trades require waiting. Waiting for the setup to form. Waiting for the cause to develop. Waiting for the breakout or breakdown to occur. And then, when the moment comes, acting with conviction. You cannot force the market to give you opportunities. You must wait for the market to present them. This is the difference between a gambler and a trader. The gambler wants action now. The trader waits for the right action. Let me tell you how to identify turning points. Turning points occur when the balance of supply and demand shifts. They do not occur randomly. They occur after preparation. At a bottom, you will see a period of decline followed by a trading range. During the range, you will see tests of the lows. You will see volume dry up on those tests. You will see price hold. Then you will see a rally attempt. If that rally is met with light supply, price will continue higher. If it is met with heavy supply, price will return to the range. The key is to watch the behavior. Is price finding support? Are the tests becoming shallower? Are the rallies becoming stronger? If yes, a bottom is forming. At a top, you will see a period of advance followed by a trading range. During the range, you will see tests of the highs. You will see volume increase but price fail to advance. You will see weakness develop on the reactions. Then you will see a breakdown attempt. If that breakdown is met with no demand, price will continue lower. If it is met with strong demand, price will return to the range. Again, the key is behavior. Is price losing momentum? Are the rallies failing? Are the reactions deepening? If yes, a top is forming. You do not need to predict the exact moment of the turn. You only need to recognize the conditions, and then you act when the turn is confirmed by price. Let me also speak about momentum. Many traders think momentum requires an oscillator. It does not. Momentum is visible in the price action itself. When price moves rapidly with strong ranges, momentum is high. When price moves slowly with narrow ranges, momentum is low. When momentum is increasing, it means the trend is healthy. When momentum is decreasing, it means the trend is weakening. You can see this by comparing the size of recent price movements to prior ones. If the last rally was larger than the previous rally, momentum is increasing. If the last rally was smaller than the previous rally, momentum is decreasing. If the last reaction was smaller than the previous reaction, momentum is increasing. If the last reaction was larger than the previous reaction, momentum is decreasing. This is simple observation, but it is powerful. It tells you whether the current move is gaining strength or losing it, and that tells you whether to stay with the trend or prepare for a change. Now let me address a question I am often asked. How do you know when you are wrong? This is a critical question, because no method, no matter how sound, is perfect. Price does not always behave the way you expect. Sometimes accumulation fails. Sometimes distribution is reaccumulated. Sometimes a breakout is false. You must have a method for recognizing when your analysis is incorrect. And the answer is always found in price behavior. If you identified accumulation and entered on a breakout, but price immediately returns to the range, you are likely wrong. If you identified distribution and exited or shorted, but price holds and rallies with strength, you are likely wrong. The market is telling you that your interpretation was incorrect. You must listen. You must respect what price is doing, not what you want it to do. This requires humility. It requires the willingness to admit error, and it requires the discipline to exit when you are wrong. This is not failure, this is wisdom. Let me now tell you about the importance of context. Price does not move in isolation. Every movement occurs within a larger structure. A rally occurs within an uptrend or a trading range. A decline occurs within a downtrend or a trading range. You must always be aware of where price is within the larger picture. Is this rally occurring after a long decline and a period of accumulation? If so, it is likely the beginning of a new uptrend. Is this rally occurring after a long advance and a period of distribution? If so, it is likely a temporary reaction within a new downtrend. The context determines the meaning of the movement. The same price action can mean different things depending on where it occurs. A shallow reaction in an uptrend is healthy. A shallow reaction after distribution is a warning. You must always zoom out. You must see the forest, not just the tree. This is how you avoid false signals. This is how you stay on the right side of the market. I want to share with you one more principle. The principle of confirmation. Do not act on a single signal. Wait for confirmation. If you see a test of support, wait for the rally. If you see a test of resistance, wait for the reaction. If you see a breakout, wait for the follow-through. Confirmation reduces your errors. It increases your probability of success. Yes, you may miss the very first part of a move, but you will avoid many false starts. And over time, this will save you far more than it costs you. The market rewards patience and discipline. It punishes haste and impulsiveness. Now, my friend, we are near the end of our time together. But before I leave you, I want to summarize the essential points. Price is truth. Everything you need to know is revealed in price behavior. You do not need indicators. You do not need formulas. You need observation, understanding, and discipline. The three laws govern all market movement. Supply and demand determine direction. Cause and effect determine magnitude. Effort versus result reveals the balance of power. The operator controls the market. Learn to think like him. Learn to see what he is doing. Learn to position yourself accordingly. Accumulation and distribution are the most important phases. They prepare the market for the next major move. If you can identify them, you can profit from the move that follows. Strength and weakness are visible in price action. Learn to read the signs. Learn to recognize when the character changes. Learn to act when the transition occurs. Turning points are not predicted. They are recognized through preparation and confirmation. Patience is your edge. Wait for the setup. Wait for the confirmation. Wait for the right moment. Context matters. Every movement occurs within a larger structure. Always know where you are in the cycle. And finally, remain objective. Control your emotions. Respect the market. Accept when you are wrong. And always, always let price be your guide. I have spent my entire life studying the market. I have watched thousands of hours of price movement. I have learned from my mistakes. I have refined my understanding. And what I have learned is this: the market is not mysterious. It is not random. It is not impossible to understand. It is simply the record of human behavior translated into price. And human behavior, while varied, is predictable in aggregate. Fear and greed drive all decisions. The operator exploits fear and greed, and the price action reveals the result. If you dedicate yourself to studying price, you will learn to see what others miss. You will develop a sense for when the market is preparing to move. You will recognize the signs of accumulation and distribution. You will feel the shift from strength to weakness and back again. This is not magic. This is skill. And skill is developed through practice, observation, and discipline. So I leave you with this advice: turn off your indicators, close your news feed, ignore the predictions, and watch the price. Watch how it moves, watch where it hesitates, watch where it accelerates, watch the volume that accompanies each movement, watch the character of the rallies and reactions, watch the tests, the breakouts, the failures, and over time, you will begin to understand. You will begin to see. And when you see, you will know what to do. The market will speak to you through price. And if you listen carefully, it will tell you everything you need to know. This is the art of reading price action. This is the path to mastery. And it is the only path that endures. Thank you for your time. Now go and study the market with patience, with discipline, and with respect. The tape never lies.